Okay, here we are back again, continuing with Chapter 5. So we've talked about different kinds of stock. We've talked about bonds a little bit. So let's talk about how companies decide what their mix of capital should be. How much of my capital should be borrowed? How much should be equity? What's the best mix of capital? And there's always a trade-off in this mix between risk and reward. So when you're creating a financial structure for a company, and you've just looked at some companies, Kirby and Tidewater, and you looked at their financial structure, I'm not sure you really thought about how it was structured, but a couple of years ago, Kirby went and borrowed some money long term, and they didn't use that money to invest in assets. They used that money to buy back their stock. So they were actually doing something with their money. They were choosing to increase their debt and reduce their equity. So changing their leverage, changing their debt to equity ratio. And why were they doing that? Because they could borrow money cheaply. So the cost of borrowed money was cheap. Interest rates are quite low right now. And they were able to do that, and then they bought back shares from their shareholders, which reduced the number of outstanding shares, which made the shareholders who didn't sell, each of those shareholders ended up owning a larger share of the company, increasing, and also because there's fewer shares, earnings per share increased, so presumably the stock price would increase also. So they were able to use debt and reduce equity and change their debt to equity ratios. That's called increasing their leverage. So they chose to do that. They didn't have to do that. They chose to do that because they thought that was a better debt to equity mix, or and cost of capital situation than what they had before. Were they right or wrong? Who knows? There's no right or wrong answers here. It's all about what works and what doesn't work, and we never know that until we actually do it. So first of all, cost of capital is composed of a variety of things, and it's a weighted average. It's not a straight average, but a weighted average of the cost of stock or equity, the cost of preferred stock, which is that hybrid, and the cost of debt. So what are those costs? The cost of debt is interest. That's pretty easy. How much interest am I paying on the debt? Cost of preferred stock is the required dividend payment. And remember, there's a little bit of a difference here because of tax treatment. So the cost of debt is the interest we have to pay minus the reduction in taxes due to the deductibility of interest. So it's not straight interest pay. Cost of preferred dividends is just the cost of the dividend. There is no tax favorability there. So the cost of the dividends is the cost of preferred stock. And then the cost of common stock is any dividends that we pay on common stock plus the growth in value of the stock. So that's part of cost of capital. So if my stockholders expect a 10% return from growth, both dividends and growth, then the cost of capital for me is 10%. If I don't achieve that 10% growth for my stockholders, they're not going to be happy. They're going to do something. They're going to replace management, replace the board of directors, or sell their stock and force the price of the stock down. So that's my cost of capital for equity. Equity holders demand higher interest rates than debt holders because they have higher risk. Preferred stockholders demand higher dividend payouts than debt holders because they have higher risk. So debt is the cheapest of these three types of capital, but also carries the highest risk for the borrower. Lowest risk for the lender, highest risk for the borrower. So because of that, a reasonable level of debt tends to reduce the overall cost of capital. Now, notice I use the word reasonable. Well, what's reasonable? What's reasonable for you might not be reasonable for me. So what's a reasonable level of debt? Well, it has to do with risk profiles. So having debt increases risk, financial risk, always, because debt has to be paid back. It's an obligation, a legal obligation to pay. So when I borrow money, I have to pay it back. So that increases risk. If I get too risky, or too leveraged is the other term for that, the cost of my debt financing will rise because lenders will say, well, I'll lend you money, but you're risky. I want to charge you a higher interest rate. So the cost of debt increases the more of it I have. And of course, the risk level goes up the more of it I have as well. So there's risk in debt, but it's cheaper than equity. So where do I go? Well, as a chief financial officer, that's a lot of what finance is about. It's about balancing the difference between debt and equity. How much do I need of each to get to the optimum level where my shareholders get the highest return and my risk is not so great that I lose the farm? So that's kind of the situation for debt. Other instruments that companies use, these are some other things. We'll talk about them in sequence. So stock options, stock rights, warrants, and convertibles. All of those are sort of hybrid kinds of things that companies may use in their capital structure. So stock options, they give the holder of the option, we grant an option to someone to buy shares of stock at a predetermined price during a specified period of time. They're very commonly issued to employees, usually key employees. So I might take a job at a company today, and it's a high-level job in the company. Let's say I'm a finance person, so let's say I got hired as CFO, Chief Financial Officer. The company is going to agree to a salary, but they're also going to offer me stock options. So they're going to give me the right to buy their stock at probably the price at the date I'm hired. If I stay for 5 years, let's say, I can buy the stock at the end of 5 years at today's price. So if I do a good job as CFO and the stock price rises at the end of 5 years, I'm going to have a substantial bonus for my 5 years of labor tied to the performance of the company's stock. So that's what stock options are. Many companies issue them, especially startup companies and high growth companies, and oftentimes they can make their holders very, very rich. So if I had stock options, if I was one of the early Microsoft employees, Microsoft paid their people in stock options because they didn't have any money to pay them in anything else. So they paid them relatively low salaries with stock options. And obviously Microsoft was wildly successful. So if I was an early employee, maybe even only a janitor, and I got stock options, I might be a multimillionaire. So because I got the right to buy stock when I started, when Microsoft stock was a couple of dollars a share, and now it's a couple of $1,000s a share before splits. So so I got a few shares of stock and I got rich. So that's how stock options work. Very, very common for employment incentives, if you will. So you may get a chance at some job at some point in time to get stock options, or maybe some of you already have stock options. That's what they are. Stock rights, very similar to an option. Really, it's the right to buy a share of stock at a stated price. Usually somewhat less than the current market price, and it's used to raise equity without the cost of a new issue. So I can offer rights to buy stock to my existing shareholders. I can raise more equity. I'm giving them a slight discount to the current price. They can buy it directly, but I don't have to go through all of the regulatory process of issuing and selling new stock because I'm selling it to my current shareholders. So if you own 100 shares, you can buy 10 more shares at a small discount to market price. The company gets the additional investment. Their stockholders get a slight discount, and the company doesn't have to go through the process of doing a public offering of the stock. So it's a way to raise more money from my existing stockholders. Warrants, also somewhat similar to options. They have a strike price above the current price, usually a price that you can buy at above the current price. And they are offered usually as an incentive to lenders. So you lend me a lot of money and I'm going to give you some warrants. If I'm successful, you can buy this stock at a fixed price, strike price. It's higher than today's price, but if we're really successful, maybe my stock will double and you can buy my stock at a discount. And usually we do that to get better interest rates or lower interest rates from a lender. And then finally, you also have convertibles. We already talked about convertible preferred and convertible bonds. These are instruments that are fixed income instruments, preferred paying a fixed dividend or bonds paying a fixed interest rate, but they can be converted to common stock at a predetermined price, usually higher than the current price, but if the company does really well, it gives someone owning preferred stock or bonds some upside potential if the company is successful. So I get my fixed income, but I have a little bit of upside potential. Convertibles are usually structured in such a way that the company ends up paying either a lower dividend or a lower interest rate because this convertible feature is quite attractive to investors. So they're willing to accept a lower fixed income amount, interest rate or dividend, with the hope that if the company is successful, they have some upside. If it's not successful, they get their principal back and they get their interest. So, stock dividends and splits, you hear about them. They really don't do anything to capital structure. They're just window dressing, if you will. It says here psychological purposes. So if a company does a stock split, they let's say you own one share, now they're gonna take that share back and give you 2 new shares. So now I have twice as many shares, but everybody has twice as many shares, so I still own the same percentage of the company that I did before. So some companies think it's important to keep the per share price of their stock at a reasonable price. That's become less important recently because there are no odd lot fees anymore. It used to be that when you bought stock, if you didn't buy in round numbers like 100 shares, you paid a higher brokerage fee. But with electronic trading, that's not the case anymore. So there's no reason to do stock splits. It's psychological that people feel more comfortable buying $50 stock than $500 share stock. But so many companies don't do splits anymore, which is why you see people like Amazon and Google with very high per share prices. Apple just did a large split. They just did a 5-for-1 split. So they took their stock from around $500 a share to $100 a share by issuing 5 times as many shares to their existing shareholders. So the stock fell to 1/5 of its previous value, and you had 5 times as many shares. You were pretty much in the same place. Has no effect on ownership interest or value. Doesn't change the balance sheet of the company. There is a psychological effect that for a short period of time after a split, stocks tend to rise, but over time they tend to find their equilibrium right back where they were. So not a big deal, but you should know about them. And then reverse splits means reducing the number of shares outstanding. So if you have let's say you have 2 shares, they take your 2 shares and they give you 1 share. That's a 1-for-2 reverse split. And that will increase the per share price. And there have been a lot of reverse splits because the New York Stock Exchange rules and some other stock exchanges say if your stock falls below a certain level, I think on the New York Stock Exchange it's $5. If your stock falls below $5 a share for a certain number of months, then you will be taken off the New York Stock Exchange. You'll be delisted. So companies have done reverse splits so that their stock, especially in the recession after 2008, where stocks fell dramatically, a lot of companies did reverse splits to keep their stocks listed so that their stock price would rise enough to be listed and fall below that cutoff line. So that's kind of the outline for various kinds of instruments that we use to raise um, capital. And here are some other ways to raise capital. So some other things here: seed capital, venture capital, public stock offerings, private stock placements, debt offerings, and leasing. We've talked about some of them, but let's go through them. So seed capital is what most startups do when they start. They have to have seed capital. They have to have some capital in order to do market research and product development, whatever it is that they're going to be doing. That seed capital usually comes from the founders, the entrepreneurs, or their friends and family. So seed capital is usually not sought out in the marketplace. It comes from inside. And it may be small or it may be large, depending on the business. And there are Kickstarter campaigns now. There's some internet seed capital. So somebody has a business idea and they go to the internet and say, if you contribute this much, when we start building stuff, we'll give you a deal or something. That's Kickstarter capital. But even before Kickstarter capital, you have to have some seed, because you have to have a plan and an idea, and you have to have that idea in form that people can understand. So seed capital is where business formation starts. And then other places that startups go is to venture capital. And venture capitalists provide early money, helping new businesses get started. They generally invest based on a business plan that is presented to them. And what they get for their investment is a significant financial share of the business and often management oversight. So venture capitalists are good and they're bad. I always avoided them in my business career because I hated giving them control. So yeah, they could provide capital, but they wanted control. And being a controlling person myself, I hated giving up control. So, but they're very important. They're a very important part of the startup culture. So how do I get enough capital to start up? And venture capitalists work on the principle that, generally most of them work on the principle that 1 out of every 5 investments they make will succeed, and the other 4 will be total losses. So if they're putting, let's say, $500,000 into 5 different ventures, so $2.5 million total, $500,000 into each of 5 different ventures, they expect that 4 of those will fail. But they also hope, or their experience shows, that the 5th one may become worth 20 or 30 or 50 times what their initial investment was. So they're going to make money because 1 out of every 5 of their ventures will succeed. Now, obviously, if 2 or 3 succeed, that's great. And if all 5 fail, that's bad. But their track records generally are that their experience is that all of these things look good to them. They wouldn't invest in them if they didn't, but only 1 out of 5 will actually succeed. But if that one's a big winner, that makes all the other losses go away, not hurt so much. Once you've raised seed capital, venture capitalists are the people who provide the working capital and or the acquisition capital. So the working capital, what I need to actually run my business. Acquisition capital, what I need to acquire another business that is part of my business plan, or acquire the assets I need to run my business. So that's where the venture capitalists come in. And venture capitalists usually get paid with that successful company by taking the stock public. So we've started a company, we've done the seed capital, we've found a venture capitalist, we're successful. Our product is selling, we're making money, we're successful. Now we take the stock to the public. We sell the stock to the public. The venture capitalists are able to cash out at that point because the public money replaces their investment. And if you're going public, the venture capitalists have succeeded. They've got that 50 or 100 times on that from their initial investment on that company. And we call those things IPOs, or initial public offerings. So the first time the public is offered the potential for buying shares. You've certainly seen IPOs in the recent past. Facebook did a huge IPO fairly recently. There's other companies that are talking about doing IPOs, and most of the things you read about are in the tech field because that's where there's a lot of startups that have grown quite fast and are now ready to be offered. A lot of IPOs in the biotech field as well, fast-growing industries. Then companies also sometimes offer secondary issues after they've raised money with an IPO. They may sell more stock to raise additional capital. Tesla just did a secondary issue fairly recently, this summer sometime, where they sold a significant amount of additional stock. Now that means their current shareholders have dilution. They own less of the company because there's new shareholders. So before there were 10,000 shares, now there's 15,000 shares. If I owned one of those 10,000 shares, I had 1/10,000th of the company, but now we've sold 5,000 more shares, so now I have 1/15,000th of the company. I own less of the company. My ownership has been diluted. But the company has more cash, so the company presumably is worth more. So secondary issues are how companies continue to raise money after they've gone public, sell more stock. There are advantages to going public. You have a much larger equity base. It makes it much easier to borrow, as well as raising funds from the stock market. Now I can borrow more. I have better recognition with the public, and the original owners, whether they're venture capitalists and or founders, have much more liquidity. They can sell their stock and still continue to run their companies or do what it is that they do. So there's an ability to raise funds for the owners, the initial owners, and they're much more liquid rather than being tied, all of their assets being tied up in one entity. Disadvantages: lots of oversight, lots of regulation, lots of reporting. For entrepreneurs, there's a loss of control. Now I have stockholders out there who might decide that they don't like what I'm doing, and I might get dismissed. So the founder of Uber got dismissed by his stockholders because of being a jerk, basically, I guess. But so they decided we can't have this, even though he was the creative genius that created Uber. We don't need you anymore. Thank you very much. See you later. So loss of control. Public companies generally have a shorter time horizon because they're reporting to the public. So private companies generally think longer term. Public companies generally think shorter term. That's a generalization, but it's relatively true. And then there is potential for liability for those founders, those officers, if they don't comply with all of the rules and regulations. So other ways to raise funds: private placements. I might, instead of selling to the public, I might go to a few really large investors and sell to them. Private placers have much less regulation. They can only be sold to what are defined as sophisticated investors, so people who know what they're doing, not the rest of us that don't know quite so much. They can raise funds very, very quickly, and a lot of companies do private placements. So who would be the people we'd sell to? It might be an insurance company that has lots of money, might be an investment firm that wants to own a share of your company. So private placements take place all the time, and they're a fast way to raise capital without going public. So that's another source of capital. We've talked a bit about bonds. Bonds can be issued either by private placements, and many are, because it's an easy way to do a bond issue, to issue it to pension funds or insurance companies or something like that. Or bond offerings can be public offerings, just the way stocks are public offerings. And bonds are better than bank financing because they can be for large amounts of money, hundreds of millions of dollars many times. They can be for very long periods of time, 10, 20, 30 years, are not unusual for bonds, so we get long-term money. And since I don't go through a bank, I can usually borrow a little bit for a little bit less money because I'm borrowing directly from the lender, whereas the bank is an intermediate, it's a middleman. So usually I pay a little less interest than I would pay to a bank. So those three reasons make bonds attractive. Bond offerings are really only available to larger companies and public companies. Pretty hard for private companies other than through private placements to issue bonds. And then the final kind of source of capital that we haven't talked about is leasing. Leasing can be very, very similar to borrowing. So I can lease a new machine, or I can buy the new machine, borrow money and buy the new machine. Lease actually acts like a loan. So it's a way to get capital. I lease the machine. I don't have to put all the capital up at once. I can put it up over time. And that's called a finance lease. And operating leases are also a way to get assets without putting all my own money into it. And that's a rental. So I can rent a warehouse rather than building it myself. So if I rent the warehouse, I have rental obligations, but if I decide I don't need the warehouse anymore, I can stop the rental obligations and leave. So leasing is definitely a different form of financing, but a very effective form of financing. It tends to reduce my operating leverage while increasing my financial leverage. And we'll talk about operating leverage a little later. So that wraps up chapter 15. There'll be short questions after the end of the chapter, and thanks very much for listening.